All right, can we continue? We are now looking at chapter 3. And chapter 3 looks at international financial markets. So remember we said our aim is to look at international financial management from a multinational corporation. But before we look at international financial management from a multinational corporation, we need to understand exactly from a macroeconomic perspective what affects the multinational corporation. So from a macroeconomic perspective, what affects what in the operations of the multinational corporations. So when you look at international financial markets, they say due to the growth in international business and investment over the past 30 years, there has been a large increase in the size and variety of international financial markets. So the main function of these markets are borrowing, lending, and risk reduction. So a complicating factor compared to their domestic equivalent is the exchange rate. So financial managers of the multinational corporation need to understand these markets in order to operate effectively. Then on the next section, we'll look at the motives for using international financial markets. So here they say, there are a number of barriers that prevent markets in different countries for real or financial assets from becoming completely integrated. These barriers include tax differentials, tariffs, quotas, labor immobility, cultural differences, financial reporting differences, and significant costs of communicating information across countries. Nevertheless, the barriers can also create unique opportunities for specific geographic markets that will attract foreign creditors and investors. For example, barriers such as tariffs, quotas, and labor immobility can cause a given country's economic conditions to be distinctly different from others. So investors and creditors may want to do business in that country to capitalize on favorable conditions unique to that country. So at the same time, these imperfections can also have a motive for developing larger international markets. So on the next section, we look at motives for investing in foreign markets. So which means we're looking at the motives of why a company or a multinational corporation would consider investing foreign markets instead of investing in their own domestic markets as well. So the first one is economic conditions, where they say investors may expect firms in a particular foreign country to achieve a more favorable performance than those in the investor's home country. So which means they're expecting a better return from their investment in the foreign country than in their own domestic country. Hence, they would consider investing in foreign markets. The second one is exchange rate expectations. So here they say some investors purchase financial securities denominated in a currency that is expected to appreciate against their own. So they can invest in securities where the currency is expected to appreciate their own. Because if they're able to do that, it basically means that before they even get a return from their investment, they're able to get a better return through appreciation of that country. A typical example of this is where we say, for example, we have South Africa and we have Botswana, right? Let's say today, the exchange rate between the two countries is 1.5 rand is equals to 1 Botswana pula. Then after 1 year, we're expecting that 1.2 rand is going to be equal to 1 Botswana pula, right? So now we're trying to demonstrate the effect of appreciation of the foreign currency against our currency. Because remember, initially we need only 1 rand 50 to get 1 Botswana pula. Now we need 2 rands to get 1 Botswana pula. So which means today, if we have for 100,000 rand, we are going to be able to get 150,000 puller, right? So for 100,000 today, we're able to get 150,000 puller. Then after 1 year, without taking the return from the investment that we have done there, right? After 1 year, one puller gives you 2 rand, isn't it? So which basically means that if we have 100, so it basically means that if we have 150,000 rand today, we're able to get 100,000 pullers. Sorry, I made a mistake there. For 150,000 rand, because remember, okay, how we do the conversion. Let me just start off by looking at how we do the conversion, right? How we do the conversion, we're going to say, if today you start off with 150,000 rand, right? It means you're going to be moving this money between the South African rand to the Botswana puller. So which means you have the rand this side, you have the puller that side, right? So which means if you start off with 150,000 rand, you want to convert this money into Botswana puller, right? So what are we doing? So how you do the conversion there is that you're going to say, which of the two currencies is stronger? One puller gives you, to get one puller, you need 150, right? So if you look at this exchange rate, which of the two currencies would you say is stronger then? Which of the two currencies would you say is stronger? Is it the rand or is it the puller? So which of the two currencies is stronger? Is it the rand or is it the Botswana puller?
It's puller.
It's the puller, isn't it? Because the currency you need less of is the stronger currency, right? So the currency you need less of is the stronger currency. So which means in this case, we are moving from the weaker currency going to the stronger currency. So we are moving from the weaker currency going to the stronger currency. Please take note of this principle. Very, very important. When moving from a weaker currency to a stronger currency, you end up with less units. The reason why I'm giving you this principle is mainly because you see later on that when they're presenting this exchange rates, they can either give you the direct exchange rate or they can give you the indirect exchange rate. So to avoid confusion, whether you're given the direct exchange rate or given the indirect exchange rate, to avoid confusion, always remember this principle. When you are moving from a weaker currency to a stronger currency, you always end up with less units. So which means when you're now trying to find out exactly, so how much of the currency do we need? It's either you're going to multiply or you're going to divide. So your choice there is you are going to ask yourself to say, if I multiply, do I end up with more or do I end up with less? If I divide, do I end up with more or do I end up with less? So which means so your choice between multiplication or division is going to be dependent on this. Is it going to give me less units? If it is, then I'm going to make this choice. Also, take note, when moving from a stronger currency to a weaker currency, you end up with more units. So when you're moving from a stronger currency to a weaker currency, you're going to end up with more units. So that's the principle that you need to make sure that you take note of. So in this case, we are moving from the weaker currency going to the stronger currency, right? And when we're moving from the weaker currency, going to the, so we're moving from the weaker currency, going to the stronger currency, we end up with what? Less units. And for us to end up with less units, it basically means that what? The 150 units that we have here, to end up with less units, we're going to be dividing by the exchange rate. Because if you divide by the exchange rate, it will give us the new number of units that we're going to be having. So which means if you say 150,000 divided by 1.5, it will give us 100,000 puller. So it basically means in this case, you're going to end up with 100,000 puller, because when you're moving from a weaker currency going to the stronger currency, you end up with less units. Are we on the same page then? Please take note of this principle. Very, very important. You're going to be using it quite a lot. Now, with the same 100,000 puller, now we are saying, after 1 year, how much do you end up with? So with the same 100,000 puller, after 1 year, how much do you end up with? Remember here, we have moved to the puller. Now we're moving from the puller going back to the rand with the same 100,000 rand, isn't it? 100,000 puller, sorry. But now the exchange is equals to 2. So what are we doing now after 1 year? We're moving from the stronger currency going to the weaker currency. And when you're moving from the stronger currency going to the weaker currency, you end up with more units. So if the exchange is 2 rand there, it means to end up with more units. What are we going to do? We're going to multiply, isn't it? So which means in this case, we're going to say 100,000 multiplied by 2. It means we end up with what? 200,000. Are we on the same page? Any questions? So that's another motive for investing in foreign markets, because when you look at the motive for investing in foreign markets, if we're expecting the puller to appreciate against the rand, if we're expecting the puller to appreciate against the rand, what do we see? We start off with 150,000 rand, we end up with 200,000 rand. So before we even check to see how much this 100,000 rand is generated as a return, by just looking at the 100,000 rand, we see that if we're expecting the foreign currency to appreciate against the domestic currency, it basically means that we can invest there because we're expecting what? To make more money. Just by movements of the currencies. Are we on the same page? Any question? Anyone lost? This principle, remember we're looking at international financial management. This principle, we are going to be seeing it a lot. And I'm going to be referring to this principle quite a lot because there are so many things that we're going to be looking at which involves the movement between currencies. And the moment we see that there's movement between currencies there, this principle is very, very important. So you need to ask yourself, which currency are we moving from? Which currency are we going? And which currency is stronger and which currency is weaker? And the stronger currency is the one that you need what? Less units of. And the weaker currency is the one that you need what? More units of. Are we on the same page? Any questions? Moving on to the third motive. So moving on to the third motive, they say, they also look at international diversification. And here they say, investors may achieve benefits from internationally diversifying their asset portfolio. So which means if you don't want to be affected by what's happening in a particular currency, you can what? Diversify by investing in different currencies as well. Because the more currencies you are invested in, if anything wrong happens in one particular country, it does not necessarily mean that all your portfolio is going to be affected the same. Even if it gives you negative returns, they are going to be evened out by the what positive return that you're expecting to earn from other investments, not in other currencies as well. And this is basically where the principle of what? International diversification comes in. Then We also look at the motives in providing credit in foreign markets. When you look at providing credit in foreign markets, this is where we are looking at what? Providing, for example, loans. So you are the institution that is giving out loans to another entity. So why would you give out, for example, loans or give debt financing to other entity? The first one is high foreign interest rates. So here they say some countries experience a shortage of loanable funds, which can cause market interest to be relatively high, even after considering default risk. So if you're expecting a higher real rate of interest to be earned in that country, then you can invest in that country because on its own, your investment is going to grow. The second one is exchange rate expectation. Creditors may consider supplying capital to countries whose currencies are expected to appreciate against their own. Because by just merely looking at the movements between currencies there, by looking at the principal amount only, like what is the example that we've seen now, by looking at the principal amount only, if the currency is expected to appreciate against your home currency, you can expect what a positive return from that movement. And then third motive would be international diversification, because you want to be able to diversify your investment portfolio. Because remember, you can either invest in equity or you can invest in what? Debt financing. So please take note of this because these are potential theory questions. Now, remember here we're looking at from a perspective where we are investing, isn't it? Now let's look at it from a perspective where we are now the ones who are needing funds. And the first one looks at motives for borrowing in foreign markets. So which means here, when you look at the first motive is what? Exchange rate expectations. When a company borrows from abroad, there are two costs that must be taken into account. The first is the interest rate, as with any borrowing. So ideally, you want the interest rate to be what? Relatively lower than your home country. The second issue that you have to take into account is, they say the second is unique to international borrowing and is the effect of what? Changes in what? Exchange rates. So if you're going to be borrowing from a particular currency, ideally you want that currency to depreciate against your own currency. So you would want your own currency to appreciate against that particular currency, so that when you pay back that money, you're paying less money as well. Are we on the same page when it comes to exchange rate expectations? Any questions? The second one is low interest rates. And yet they say some countries have a large supply of funds available to lend compared to the demand by borrowers for these funds. So because if there's a high supply of funds than the demand of the funds, when you look at the demand curve and the supply curves there, what do we see? We expect the interest to be what? To be low. On the next section, we look at the foreign exchange markets. And under this, we're going to look at foreign exchange transactions. And when you're transacting in the foreign exchange markets, when you look at foreign exchange transactions, you can either have transactions in the spot market. And when you look at transactions in the spot market, they're saying the most common type of foreign exchange transaction is to immediately exchange at the so-called spot rate. The market where these transactions occur is also known as the spot market. So when you're looking at the immediate buying or selling of currencies, right? If you want immediate to do it today, like for example, if you say, I want to buy or sell a currency today, it's immediate, it's happening now, then it means you're going to be transacting in what? Spot market. Then there are other markets that you can also going to be able to transact in as well. And in this case, but before we look at these other markets as well, we also need to find out exactly, so what is the spot market liquidity? And here they say the spot market for each currency can be described by its liquidity, which reflects the level of trading activity. The more willing buyers and sellers there are, the more liquid a market is. So the spot market for heavily traded currencies such as the euro, the British pound, and the Japanese yen are very liquid. And conversely, the spot markets for currencies of less developed countries are less liquid because there's not that much trading happening between those countries and what? In the other countries as well. And because of this, it means that the currencies out are going to be considered to be less liquid. Then there is also the forward transactions. So instead of you transacting today immediately in the spot market, you can enter into a contract where you're saying you either want to buy or sell a currency sometime in the future. And one typical transaction would be the forward transactions, where they say, in addition to the spot market, a forward market for currencies enables a multinational corporation to lock in the exchange rate at which it will buy or sell a currency. So a forward contract specifies the amount of a particular currency that will be purchased or sold by the multinational corporation at a specified future point in time and at a specified exchange rate. So the date on which the transaction is going to happen, the amount that is going to be transacted, and the predetermined exchange rates are going to be determined today, although it's going to happen in the future, but you'll be knowing exactly how much are we buying or selling now, and you will be knowing exactly when are we going to be buying or selling. Is it after 3 months, after 6 months, or whatever period of time as well. On the next section, they look at the attributes of banks that provide foreign exchange, right? So which means they say the following characteristics of banks are important to customers in need of foreign exchange, although we're not going to go through it in detail because I don't see anything that I would say would be highly examinable. But in most cases, for customers, when they are looking at being able to buy or sell foreign currency, these are the issues that they take into account. They look at the competitiveness of the court when they are buying the foreign currency. They look at the special relationship with the bank. Am I a customer of that bank, or am I not a customer of that bank? Am I able to get a concession from them? They look at the speed of execution. How soon can I be able to get the foreign currency when I need it? They look at the advice about the current market conditions as well to see the market conditions currently are favorable for me to be able to buy or sell that currency. And they also look at the forecasting advice to say, so what are we expecting to happen in the future when I eventually want to buy or sell that currency in the future as well? So when you look at foreign currency transactions, when you look at the foreign currency transactions, there is, remember you're saying, how much of the domestic currency are we needing for the foreign currency, or how much of the foreign currency are we needing for the domestic currency as well? So that's basically how the pricing of the currencies is done. So the first type is what we refer to as the direct quote, where they say, this is where you're asking yourself, what is the number of units of the home currency for one of the foreign currency? So we're saying, how many number of units of the domestic currency do we need for the foreign currency? So how many units of the domestic currency do we need for the foreign currency? So in this case, our domestic currency is the rand. So we're saying, how many units of the rand are we in need of? So how many units of the rand are we in need of for 1 unit of that of the foreign currency? So which means that this is basically what we refer to as the direct quote. Then for the indirect quotes, they say, when you look at the indirect quotes, you're also saying the indirect quote is the number of units of the foreign currency for 1 unit of the home currency. And here they say there is a reciprocal relationship between the two. The indirect quotation is equal to 1 divided by the direct quotation. So which means that if you are given the direct quotation, if you want to find out exactly what the indirect quotation between the currencies is, right? You're going to say, today, for the indirect quotation, you're going to say it's going to be equal to 1 divided by 1.50. And if you say 1 divided by 1.50, how much do you get? How much do you get? You get 0.67,
0.67.
isn't it? So you get 0.667, which basically means you need 0.6667 gives you 1 South African rand. So 0.667 units of the puller gives you 1 South African rand. So this would be the indirect cost, because you're saying how many units of the foreign currency do we need for 1 unit of what? The home currency. Then after 1 year, you're saying 1 divided by 2. And this gives us 0.5. So it's saying 0.5 puller is equals to 1 South African rand. And the relationship is still holding. What do we see that happening between the rand and the puller? We are saying to get 1 puller, we need one rand 50. And after 1 year, to get 1 puller, we need 2 rand. So the puller is that appreciated in value, isn't it? Because we are needing more of the rand to get 1 puller. And the same should hold here as well. Initially, we're saying to get 1 rand, you need 0.667 units of the puller. But after 1 year, we need less of the puller to get the same 1 rand. Hence, we're saying the puller is what? Appreciated in value. So this, whether it's the direct quote or the indirect quote, the relationship should always hold. Are we on the same page? Any questions? So here they give us an example, but we have already looked at it previously. So they give us this example, but we have already looked at it previously, where you are looking at the different quotations as well. It's still the same, it's basically the same. On the next section, because we looked at it from a perspective of the South African rand and the puller, which is more practical to us. Then there is also what we refer to as the bid-ask spread of banks. So here they say commercial banks charge fees for conducting foreign exchange transactions. So at any given point in time, the bank's bid or buy direct quote from a foreign currency will be less than the ask. So that this is basically what results in the bid-ask spread. So when you look at the bid-ask spread, this is where we're saying, as an example, let's look at it from a South African rand perspective, or from a South African bank's perspective. The South African bank can say, if we're going to buy from you, this is what we refer to as the bid. So when we're looking at buying from you, this is what we refer to as the bid, right? So the bid price is basically the price that they're saying 1 rand 50 buys you 1 South Africa, 1 Botswana puller. So this would be the bid price. Then the ask price is where they are going to say, for example, if you want one Botswana pula, we sell it to you for R1.55. So the bid-ask spread is basically how banks are able to make money. Because if you come to them and you say you're selling foreign currency, they'll buy it from you at a lower price. So they'll buy it to you at a price of 150. And if you go and you say you want to buy the puller, they'll sell it to you at a higher price. So the difference between this price that they're buying from the bank's perspective and this price that they're selling from the bank's perspective as well is what we refer to as the what? Bid-ask spread. So that's basically how the banks make money. A typical practical example of it, before you even look at the case of banks as well, from a common practice that you see is just like how car dealerships work. You go to a car dealership today and you want to sell your car, they can say, this car, we'll buy it from you. That's the bid price. We'll buy it from you for 150,000 rand. You sell them for 150,000 rand. Immediately, when someone else comes and say, I want to sell this car, they will now sell it to you at the ask price. And maybe they say, this car, we're going to sell it for 175,000 rand. So the bid-ask spread in this case is the difference between the price that they are buying it and the price that they're selling it. Which means that the bid-ask spread in this case is going to be the 25,000 rand profit that they're going to make. Are we on the same page when it comes to the difference between the bid price and the ask price? Please take note of this as well. So looking at this, all right, let's look at it from, okay, go through these examples so that you can see how I was trying to avoid going through examples from a British pound perspective, but we can just have a look at it as well. Can we first have a look at this particular example and we go through it together? Can you quickly read through the information given on this example and we go through it together? So on the question, they tell us that, so on the question, they tell us that 4 units of the lottie gives you €1. And at the same time, 0.68 units of the pound gives you €1. And then they also tell us that 6 units of the lottie gives you £1 pound. So based on this, they say, if you check on the question, they tell us that he wonders if we changed 1,000 British pound into Polish lottie. So if he changes 1,000 units of the British pound into the Polish lottie, so which means the movement in the arrow is straight moving there, and then converted this Polish zloty to euros. So you're moving there to the euro, and then converted the euros back to the British pound, which is this triangle direction. Would he have 1,000 pounds he started with? So he works out this and find out exactly so how much he's going to end up having as well. So to do this calculation, remember we're given that initially this person is starting off with 1,000 pounds. He's moving here, he moves there, and then he's moved back. So now you have to try to find out exactly, so how much does this person end up with? So first transaction is moving from the pound to the Polish lottie currency, isn't it? So what do we see? 6 units of the lottie gives you £1. So which means in this case, we're given the British pound, so we're moving from the stronger currency going to the weaker currency. So when we're moving from the stronger currency going to the weaker currency, do we end up with more units or do we end up with less units? So if we're moving from the pound going to the weaker currency, do we end up with more units or do we end up with less units in this case?
More units.
So I'm going to multiply or divide given the exchange rate. To end up with more, given that the exchange rate is 6 units, gives you 1, isn't it? Means we're going to multiply, isn't it? Are we on the same page? It means we're going to multiply. And if we multiply, how many units do we end up with? We end up with what? 6 units of the lottie, isn't it? We're now here. Second step, we now need to move from here going to the euro, isn't it? And for us to move from here going to the euro, what are we going to do? 4 units of the lottie gives you €1. So you're moving from the lottie going to the euro. Do we end up with more units or we end up with less units?
Less units.
We end up with less units. And for us to end up with less units in this case, we have 6,000 units. To end up with the less units, we're going to divide by the exchange rate of what? Of 2. So how much of the units of the euro are we going to end up with? Are we on the same page so far? Oh, sorry, it's 4 units, right? It's 4 units of the lottie gives you €1. So we're going to what? Divide by 4. And 6,000 divided by 4, how much do we get? we end up with 1,500 units of the euro, isn't it? Then from there, step number 3, we're now going to move from the euro going to the pound. And we're moving from the euro going to the pound. So do we end up with more units or we end up with less units?
Less units.
We end up with less units because the euro is the weaker currency. Because the currency which is stronger is the one that you need less units of. So you're moving from the weaker currency going to the stronger currency. So for us to end up with less units, we have 1,500 units of the euro. To end up with less units, are we going to multiply or divide?
Divide.
If we divide, how much do we end up with? If you say 1,500 divided by 0.68, do you see that you end up with 2,206, isn't it? But remember, we said when you're moving from the weaker currency going to the stronger currency, you end up with less units. So to end up with less units in this case, we're going to multiply. So your choice of multiplication of division is going to be dependent on what results in you ending up with less units in this case. For us to end up with less units, we're going to multiply. And this gives us 1,020. So we know we started off with 1,000 pounds. We're ending up with 1,020 pounds. So your return is equals to the end value over the beginning value minus 1. Then you multiply that by 100. So your percentage return in this case is equal to your end value is 1,020. Your beginning value is 1,000 minus 1. Then this multiplied by 100 means you are able to earn a 2% return from this. Are we on the same page? Any questions? Anyone lost?
The confusion comes from the third one when we move from when we compare the pound with the euro, we're moving from the euro to the pound. And normally when we moving from a less stronger to a stronger, aren't we dividing? And then now, obviously, if we divide, it's going to be more. In this case, we multiplied. And obviously, it makes sense that we multiply. But now, I'm not following the process because now it differs from the second one, which is number 2, whereby
now,
we divided.
There are 2 things that you have to check when you're moving between currencies. The first thing that you have to check is which currency is stronger and which currency is what? Weaker. That's the first thing that you have to check. So on this last stage here, the British pound is stronger and the euro is weaker, isn't it? Are we in agreement there?
Yes, we are.
Right? So which means you're moving from the weaker currency going to the stronger currency, isn't it? So your choice of whether you're going to multiply or it's either you multiply with the exchange rate or you divide. So it's either you're going to multiply or you're going to divide. But your decision on whether you're going to multiply or divide is going to be based on that rule that I gave you. In this case, we said when you're moving from the weaker currency going to the stronger currency, you end up with what? Less units, isn't it? So now you're going to ask yourself to say, to end up with less units. So our ultimate aim is to end up with less units. How many units do we have? We have 1,500 units. So to end up with less units, What happens if we divide? If we divide, we end up with more units, which is not what we want. So to end up with less units, if we multiply, we end up with what? Less units. Hence, we're going to decide what to multiply. So your choice of whether you're multiplying or dividing is dependent on what is happening. Are you moving from a stronger currency to a weaker currency? Or are you moving from a weaker currency to a stronger currency? That will determine whether you multiply or divide, because you're saying, if I'm going to be moving from a weaker currency going to the stronger currency, whatever happens, I should end up with what? Less units. So now you're going to say, for me to end up with less units than I have, what would result in me ending up with less units? To end up with less units, should I multiply? Or to end up with less units, should I what? Should I divide? Are we on the same page then?
Yeah, we are. Thank you.
Okay. Any questions? Any questions? On the next section, they also give us another example. So on the next section, they also give us another example. So they give us example. Can you quickly read through this example and we'll go through together? Remember, we said the bid price is the price at which the bank buys from you, foreign currency from you, and the ask price is the price at which the bank sells foreign currency to you, isn't it? So here they're telling us that you are in France and you are sitting with 1,000 euros. So you're in France, you're sitting with 1,000 euros, and then they give us the bid ask prices there. So we are given that the bid price, the ask price for the foreign currency, right? The bid price is given as 1.28 euros is equals to $1. And the ask price is 1.31 euros is equals to $1. So what is going to happen? First, you're going to buy foreign currency. Then after that, you're going to sell the foreign currency, right? Nothing else has moved. But because things have changed, immediately you want to buy foreign currency, and just after that, you decide to sell the foreign currency as well. So now we need to find out exactly, so what happens? So on step number one, if you buy foreign currency remember you're starting up with 1,000 euros. So you're starting off with 1,000 euros. So which means with 1,000 euros, you're going to convert 1,000 euros into US dollars, right? So, but remember, if you're going to be buying the foreign currency, in this case is the US dollar. So if you're going to approach the bank and you say, I want to buy foreign currency, they're going to sell you the foreign currency at the ask price, isn't it? So if they're going to sell you the foreign currency at the ask price, it basically means that for 1,000 units of the euro, you are now needing to find out exactly how much of the US dollar are you going to end up with. So to find the amount of money that you're going to end up with in US dollars, remember the ask price is 1.3 euros, 31 euros is equal to $1 US. Which currency is stronger here? The US dollar or the euro? Which currency is stronger?
The euros.
Remember, the currency you need less of is the stronger currency. So which means you need less of the US dollar to get one. So to get $1 US, you need 1.31 euros, isn't it? So in this case, the euro is the weaker currency and the dollar is the stronger currency. So what are we doing? We're moving from the weaker currency going to the stronger currency, isn't it? So if you're moving from the weaker currency going to the stronger currency, do you end up with more units or you end up with less units? When you're moving from the weaker currency going to the stronger currency, do you end up with more units or you end up with less units? You are going to end up with less units. Please take note of this. When you are moving from the weaker currency going to the stronger currency, you are going to end up with less units. And if you're going to end up with less units, to end up with less units in this case, we're going to divide by 1.31. So this will give us the equivalent amount in US dollars. So to end up with less units in this case, you're going to divide by 1.31. So 1,000 divided by 1.31, it means in US dollars, you end up with $763 and 36. So you end up with $763 and 36. Then after that, immediately after that, you are now sitting with foreign currency, isn't it? But then you change your mind to say, you know what? I no longer want the foreign currency because I'm no longer going for the trip. So what are you going to do? You are now going to sell the foreign currency back to the same bank, right? Immediately after that. But if you're going to be selling foreign currency, the bank, because it's the one that is buying the foreign currency, they'll buy the foreign currency at the bid price. And the bid price is equals to 1.28 euros is equals to $1 US. So which means in the second scenario, you're now moving from the stronger currency going to the weaker currency, isn't it? But because you're selling to the bank, the relevant price would be the bid price. So because you're selling foreign currency to the bank, the relevant price would be the bid price. So which means in this case, it would mean you have a situation where you're now saying, I have 763.36 units of the US dollar. I'm going to now sell these units to what? To the euro. And whenever you're moving from the stronger currency to the weaker currency, you end up with more units. And if you're going to end up with more units, what are you going to do? It basically means that you're going to multiply it by 1.28 to see exactly how much of the euros you end up with. So you end up with 977.10 euros. Are we on the same page? Please take note what price is relevant when the bank is buying and what price is relevant when the bank is selling the foreign currency. Are we on the same page? Any questions? Anyone lost? So the bid price is when the bank is buying foreign currency. And the ask price is when the bank is selling foreign currency. So if you look at the example that we have, this is exactly what they're trying to explain to us. So which basically means that from 1,000 euros, you end up with 977.10 euros. So which means in this case, you end up losing out on 22.90 euros, which is about 2.29% less return. And even if you look at the difference between the bid ask prices as well, you see that 1.31 minus 1.28 divided by 1.31, it will give you the percentage difference in percentages as well, which is basically the loss that you're going to be making by just merely looking at the difference between the bid ask price. So here they say, when you look at the comparison of the bid ask spread among currencies, they say the differential between a bid quote and ask quote will look much smaller for currencies that have a smaller value. As stated above, the differential can be standardized by measuring it as a percentage difference between the two rates divided by the ask rate, which is basically the first part of the transaction. So they also give us this from the perspective where you are now having you're basically having what? The indirect quotation as well. So they give us this example. Can you quickly read through this example and we'll go through it together? So here, they give us basically the same example, but using different currencies. Because here they say, if the bid-ask spread between the currencies is where we are saying the bid price is 0.005 British pounds is equals to 1 yen, and the ask price is 0.0052 is equals to 1 yen, right? If the investor or if the individual or the traveler starts off with 1,000 pounds, they are going to be now converting the 1,000 pounds into the yen, going to the yen, isn't it? So remember we said if they are going to be converting the 1,000 yen going into the yen, in this case, that it basically means that the bank is the relevant price in this case is going to be the ask price, which is 0.0052 British pounds is equals to 1 yen. So which means if they are starting off with 1,000 pounds, if they're now going to be moving from, it basically means that they are going to be moving from this from the stronger currency going to the weaker currency, which means they're going to say 1,000 divided by 0.00052. It would mean they end up with 192,308 yen, because they're going to end up with what? More units, because they are moving from the stronger currency going to the weaker currency. But then after that, immediately, they now say, you know what? We want to sell this amount of yen that we have because we're no longer traveling. So what is going to happen? They're going to sell the yen back to the British pound at the bid price, which is 0.005. So which means if they're having 192,308 yen, if they're going to now move from the weaker currency going to the stronger currency, they're going to end up with less units. So that to end up with less units, they're going to multiply by the bid price at which, because now they are the ones who are going to be selling what? The foreign currency. So if they multiply that by 0.005, they'll end up with 961.54 British pounds. So which means they end up losing out on 38.48 British pounds, which is basically a loss to them of what? 3.846%, which is higher than the loss that they would have had because of the what? Different spreads between the currencies. If you compare it with what? With the previous example that we had. So which means, as a formula, the bid-ask spread as a percentage is given as the ask rate minus the bid rate over the ask rate. So the bid-ask spread as a percentage is given as the ask rate minus the bid rate over the ask rate. Are we on the same page when it comes to this example? Any questions? So here they say, in the following discussion and in examples throughout much of the text, the bid-ask spread will be ignored. That is, only one price will be shown for a given currency to allow you to concentrate on understanding other relevant concepts. So these examples depart slightly from the reality because the bid and ask prices are in a sense assumed to be equal. Although we have seen in previous examples that in previous example or in previous assignments as well, they've given us questions where they ask us to look at the relationship between the bid-ask spread when you're looking at what? Triangle arbitrage, and we're going to look at it later on as well in the chapter, in the following chapter. So here they look at the factors that affect the spread. And the first factor that affects the bid-ask spread is the order cost. And there they say, order costs are the cost of processing orders, including clearing costs and the cost of recording transactions. And one can also result in a higher bid-ask spread, or in the difference between the bid-ask, the amount of the bid-ask spread would be the inventory costs. The inventory costs are the cost of maintaining an inventory of a particular currency. So holding an inventory involves an opportunity cost because the funds could have been used for some other purpose as well. So the higher the inventory cost, the higher the bid-ask spread. Then there's also competition, where they say the more intense the competition, the smaller the spread quoted between what? By the intermediaries as well. And the next one is the issue of volume. The more liquid currencies are, less likely to experience a sudden change in price. So the more liquid the currencies are, the less the bid-ask spread. Then the next one is the currency risk. Some currencies exhibit more volatility than others because of what? Economic or political conditions that cause the demand for and supply for the currency to be to change abruptly. So if the currency risk is lower between the currencies, it basically means that what the bid-ask spread is expected to be lower as well. On the next example, we look at cross exchange rates. So when you look at cross exchange rates, this is where you're looking at moving between one currency to another currency, then another currency as well. Like, for example, when we look at typical cross exchange rates, we are typically given 3 countries. Like, for example, in this case, they give us the exchange rate between the UK British pound, the Mexican peso, and the Australian dollar as well. So to understand this example, they give us that example above. Can you quickly read through the example below? Then we go through together. Hey, sorry, I didn't realize that my mic was on mute. So what we're saying is that when you look at the examples that we have, remember we're given the exchange rate between these two currencies as well. So to find the cross exchange rate, is where we are saying we have a common currency, which is the British pound. So we have a common currency, which is the British pound. And we are told that 2.3 units of the Australian dollar gives you 1 British pound, and 20 units of the new peso gives you 1 British pound as well. So which basically means the common exchange rate in this case is the British pound. So if the common exchange rate is the British pound, it means that to find the cross exchange rate, because we're not given the assumed exchange rate between these two currencies. So to find the cross exchange rate between these two currencies, you're going to say, first of all, you're going to say, which currency do you need more of to get the common currency? And in this case, the currency you need more of to get the common currency is the new peso. So you're going to put it on the numerator. Then the currency you need less of to get the common currency is the Australian dollar. So I'm going to put it, get what? They put it on the denominator. So I'm now going to find out exactly how many units of the numerator do we need to get 1 unit of the denominator. So you're trying to find out exactly how many units of the numerator do you need to get 1 unit of the denominator. So in this case, it would mean 20 divided by 2.3 means you need 8.7 units of the new peso to get what? 1 Australian dollar. So this is basically how you're able to determine the cross exchange between the currencies there. Are we on the same page on how we are able to determine the cross exchange rate between the currencies? Remember, you are given the exchange rate between the Australian dollar with the common currency and the new peso with the common currency. So the common currency in this case is the British pound. So you're trying to find out exactly, so what would be the assumed exchange rate between these two currencies, which is not given. So that's basically what we're trying to determine with what? Cross exchange rate. So to find the cross exchange rate, we're going to say, which currency do we need to get the common currency? We need what? The new peso. So we're going to put it on the numerator. And which currency do we need less of to get the common currency? Is the Australian dollar. So you're now trying to find out exactly how many units of the common of the weaker currency how many units of the new peso do we need to get 1 unit of that of the Australian dollar? So I'm going to say 20 divided by 2.3. It would mean to get 1 Australian dollar, which is the new denominator, we need 8.7 units of that of the new peso. So that's basically how we're able to determine the cross exchange between the peso and the Australian dollar. Are we on the same page? So looking at this example, that's why you see that they say, so to work out the cross exchange rate, 1, equate the currencies to 1 unit of the third currency, which is basically what has already been done here. Then use the equation approach to derive the exchange rate, which is the second part of the calculation. Then on the next section, we look at the currency futures and options market. And here they say, a currency futures contract specifies the standard volume of a particular currency to be exchanged on a specific settlement date. And we'll look at it in detail later on when you look at chapter 5. Then they also say currency options contracts can be classified as calls or puts. So please take note of those definitions as well, where we say a currency call option provides the right to buy a specific currency at a specific price within a specific period of time. And it is used to hedge future payables. Then a currency put option provides the right to sell a specific currency at a specific price within a specific period of time, and it is used to hedge future receivables. And we'll look at it in detail when we look at currency derivatives. Take note of these definitions, but we'll look at this in detail when we look at currency derivatives in chapter 5. Next, we look at international money markets. So which means instead of getting money or financing for the long period of time, we can also look at getting financing in the shorter period of horizon as well, which is basically getting financing in what? In the money market. And when you look at the market efficiency, take note of these definitions, where they say, rather, efficiency refers to how well information is used in the marketplace. And on the next paragraph, they say, the role of the market is to ensure that information is available to all traders. And the paragraph after that, they also say, all information relevant to valuing currency is about the future. Then the next paragraph after that, on the second sentence, they say, there are 3 types of market efficiency. It can be the weak form, the semi-strong form, and the strong form. A weak form efficiency requires that currency prices move randomly, at least in the short term. So there's basically random movements of currency prices. That's the first assumption. Then the semi-strong form efficiency requires that prices reflect all published information. So strong form efficiency requires that prices reflect all published and private information. So with the strong form of efficiency, we're basically saying that there's no room for insider trading, mainly because private information and public information is basically assumed to be available to all participants in the market as well. On the next section, we look at the origins and development. But when this section, we don't have to worry much about it because it's basically looking at the origins and developments of the money market and the bond markets as well. I don't expect this to be coming in there as questions in the exam. So don't worry much about that section. The next section that we're going to be looking at quickly is the comparing interest rates among currencies. Although we're going to look at it, we're not going to go through too much in detail when we come to this section. You just need to know the theory sections of this. So here they say interest rates vary between countries due to 2 factors: different inflation rates and different risk. So expectations related to inflation and risk derive changes in the demand and supply. So here they say the supply and demand schedules for the British pound for Mexican currency are compared for a given point in time as in exhibit 3.5. So they give us this exhibit 3.5, which is the exhibit which is here. So this gives us the demand and supply of the British pound against the Mexican peso. So which means that in this case, we look at the demand and supply curve from the British pound perspective, and then we look at the demand and supply curve from the Mexican peso perspective as well. So here they say the demand schedule for loanable funds is downward sloping for any currency, which simply means that the quantity of funds demanded at any point in time is inversely related to the interest rate level. So that is the total amount of a loanable funds demanded at any given point in time is higher than the cost of borrowing, which is lower. So the supply schedule for loanable funds denominated in a given currency is upward sloping. So which means the total amount of loanable funds supplied is at any given point in time is positively related to the interest rate level. So that is the total amount of loanable funds supplied to the market is higher if the interest offered on savings out are equal to higher as well. So that's why you see that the demand curve is downward sloping when interest rates are changing, which means that when interest rate goes down, the quantity demanded goes up. But at the same time, the supply curve as well, when interest rate goes up, the supply curve goes up as well. So that's basically what they're trying to explain when you look at exhibit 3.5. So the last section, we look at international financial markets and where the multinational corporation fits in as well. So we look at international financial markets and we also see exactly where the multinational corporation fits in. So here we're given that with the multinational corporation, it's given here. Then we have the foreign exchange markets. Then we have the products, and it's dealing with what? Products and subsidiaries as well. And remember, all these dealings, they go through foreign exchange markets. So which means when it comes to product in the markets, there is going to be exporting and importing of products in the markets in the when you look at the flow diagram between the multinational corporations and the outside world. Then with the subsidiaries as well, there is going to be movements where they're saying the multinational corporation can be importing goods from the subsidiary, which is upward, going in this direction, or they're going to be exporting goods to the subsidiary, which is going down that downward direction as well. And at the same time, there can also be a flow between the subsidiary and the multinational corporations when it comes to the dividends remittance. Because if there's going to be any dividends remittance and interest payments there, it basically means that there's going to be that upward movements, or there's going to be that movement, which is basically a back and forth movement between the investment. Because remember, the multinational corporation moves money to the subsidiary, and then the subsidiary pays the dividends and interest payments to the corporation, so depending on exactly what the flow is going to be, who's borrowing from who as well. Then there's also when you also look at the relationship between the multinational corporations and the subsidiary with the financial markets as well. Where when you look at the financial markets, we're looking at the long-term international stock markets, in the medium term, the international bonds markets, and in the short term, the international credit markets as well. And both the multinational corporation and the subsidiary, there's going to be movements here where we're looking at our multinational corporation having a foreign direct investment or portfolio investments and borrowing in the financial markets. And the subsidiary can also do the same transactions in the financial markets as well. And also the subsidiary can also have a backwards and forward direction when it comes to the financial markets, when it comes to dealing with the financial markets. Because remember, when they need financing, they can go to the financial markets. And when they need to invest money in the short term or in the medium term or the long term, they can go to the financial markets as well. So this basically shows you the foreign cash flow chart for a multinational corporation when it comes to foreign exchange markets and the financial markets as well. And with this, what subsidiaries. Is there any question regarding this exhibit? Any questions? So this is where we end when it comes to chapter 3 of the textbook. So this is where we end when it comes to chapter 3 of the textbook. So in the next chapter, or in the next class, we're going to look at chapter 4 of the textbook. So in the next chapter, we're going to look at chapter 4 of the textbook, where we're now saying, so how do you determine the exchange rate? So how do we determine the exchange rates as well? So in the next chapter, we're going to be looking at chapter 4, which looks at exchange rate determination. Are there any questions on what we have done today? Any questions? All right. If there are no questions, this is where we end today. Please try as much as possible to review the things that we've done, and we'll always make sure that we are going to make these videos available to you so that you also use them to prepare the classes for those who were not able to attend today, and also if you want to be able to review what we've done today as well, so that you have a better understanding. All right, if there are no questions, enjoy the rest of your day. Please make sure that you try as much as possible to read through in advance, because if you're able to study in advance, you're able to ask questions on concepts that you still don't understand as well. All right, enjoy your weekend.